Hello everyone, welcome to CAIIB English Medium. This is CA Aarti and I hope you all are doing good. So as you know, this is the particular series for upcoming CAIIB June 2025 exam. So if you are visiting to this particular channel for the first time, do subscribe it, share with your friends and colleagues and like this session so that you can revise it afterwards also. Chaliye, so today we are going to start your Module B. Already we completed your Module A, so you can watch all units in your Module A now. Okay. Now we are starting with your Module B of your ABFM, that is your Unit 7. Sources of Finance and Financial Strategies. So basically why we need finance, let's start with this. Firstly, why there is a need for finance in any business organization. So the need is for everyday bill payments, for take over any bits, for replacing their existing machines, or for purchasing or for acquisition of any land, correct? For internal growth we required finance, for expansion, for starting up any new business, basically for each and every activity from day-to-day activity till your expansion activity, we require money. So in your ABFM, we are not going to call that money directly as money. We are going to call that money as finances. What are the sources of finances? Basically, how you can arrange this money. Okay. So all businesses need finance to start and run. For starting any new business, for running your business, for starting any new unit, for starting any new department, you require money. And in ABFM, we are not going to call that money, but we are going to call that as finance. Then, initial finance is provided by the person who originate the business idea, known as owners or promoters. So basically, who is starting their business or who is having any idea of any business, then they are known as owners. So basically, in starting, they are only the one who is going to bring the money. Okay, by their own FD, by their own savings, through that they are generating those money. So that is the first thing when as an initial finance, when we are talking about initial finance, means when you are starting your own business, you require funds, you require money. So you are using your own deposits, your own savings. So in initial phases of any business, you are using your own initial money. So here you have owners and you have promoters, and gradually you can take loans from bank, gradually you can issue your shares in the market. So slowly and gradually you can increase your different sources of finance, but initially as an owner you only require to bring the money. Okay, so this is what need for finance. For starting, for running, for expansion also you require money. Chali, so what are the different types of finances? Now basically in exam, now this is very important. Different types of finances. First is your equity capital, next is your internal control accrual, then next is your preference capital, then term loans, debentures, alternative financing strategies. So one by one we are going to cover different types of finances. Chaliye, so let's start with the first, that is your equity capital. Now this equity emerged with the arrival of your corporates. Okay, basically this equity emerged after the establishment of corporates, big companies, big MNCs, when they are listing their own shares in the share market like Bombay Stock Exchange or National Stock Exchange. Through that we emerged this term equity. But what is the true definition? So basically when we say a capital, okay, we have equity and we have one capital also. So this capital is what? The amount invested by the promoter to establish a business. So basically we can say your promoter or your owner, when they are bringing any amount for starting any business or for running their own business, that is their capital. Okay, so in accounting terms, the amount remaining after selling all assets and pay off all liabilities, that is your capital. Now, how to calculate capital for any business? Whatever assets you have, in that you subtract liabilities, and liabilities generally is your outside liability. Okay, now outside liability means what? When you have taken loan from bank ठीक है, suppose you have taken bank loan, you have borrowed some money from your friends. That is what outside liability. Assets that you purchased and you have the control, means you are the owner or you control those assets. You are controlling those assets. That is your asset, okay, which is giving you future economic benefit. So when you are subtracting your assets minus liabilities, whatever amount you get, that is your capital. This is the formula. That is the formula through which you can calculate capital. Capital equal to assets minus liabilities. Liabilities is your obligation that you need to repay, okay, in future, like a bank loan or any friend's loan or any relative loan. So that is your liability. After repaying whatever amount is left, that is your capital. Now, owner's contribution is what? Capital includes the money brought in by the owner at the business setup and profits retained over time. So when your owner is bringing amount for running their business, for starting their business, that is your owner's contribution. So equity capital is what? In which, in starting, okay, whatever owner is bringing. As a owner, what you are giving to your business, that is what? Equity capital. Now, if you are holding any company's shares and you are giving in return any amount, then you are giving them, then you are holding any equity. Okay, you are considered as equity capital. So that is about your equity capital. Chali, now we are going to see different other terms related to equity capital. First term is your authorized capital or nominal capital. Whenever you are starting any business, you need to prepare legal documents. Those legal documents are your MOA and AOA. During your incorporation of any company, okay, you require legal documents. Like when we are crossing 18 age of, then we prepare PAN card, okay, we have Aadhaar card, we have driving license. So like that, even company, even when they are starting, okay, we require some legal documents like MOA, AOA. MOA is your Memorandum of Association, AOA is your Article of Association. So if you want to know about that company, who are their owners, who are the contributors, what are their objectives, what are their goals, what are their basic agenda, what are their ethics, what are their values, you can see this MOA and AOA. So these are the basic legal documents. So in starting, whenever any company is incorporated, they are writing about this capital. Okay, whatever amount they are writing in this MOA, that is your authorized capital. That is the maximum capital any company can raise. That is what authorized capital. So this represents the maximum amount of capital that the company is authorized to issue, which can be any instruments as the board decides. Board decides means you can say as a management decides. Okay, so this is prescribed in MOA, AOA of the company, and in case of any change, the company must go to the shareholders as prescribed in the Act. So basically, if you want to know what is the maximum capital any company can issue or any company can raise, that is your authorized capital or nominal capital. If in your MOA they are giving rupees 10 crore as your authorized capital, then you cannot raise rupees 11 crores from the market. Okay, means you are doing violation of your legal documents. That is the authorized capital. This is the maximum amount that you can raise now, which is also known as authorized capital or nominal capital. Next term is your issued share capital. Issued share capital means part of authorized capital issued to public for subscription. Now if you see any big companies, they require more amount of finances. Okay, so basically owners cannot bring this much amount, so they raise from the market. They issue their shares through IPO, through common public, and they are generating the money. So remember, if you have any authorized capital, suppose this time your authorized capital is 5 crores. So you need to issue within this limit only. When you are issuing, suppose rupees 2 crores from the market, okay, this 2 crores you raised from the market, that is your issued capital. Issued capital is a part of authorized capital which is issued to public for subscription. Basically you issued this amount to public for subscription, like they are going for IPO, okay, at that time public are contributing in that particular amount. So that is what issued capital. Next term is your subscribed capital. Portion of the issued share capital that is subscribed to by the public, applied for and allotted by the company. So basically first you have authorized capital, your maximum limit, okay, which you cannot violate. Then next is your issued share capital. Your management decided to raise suppose 2 crores from the market, that is issued capital. Now when public are subscribing to this particular amount, okay, when companies are issuing IPOs, and public are actually doing the subscription part, that is what subscribed share capital. As a company you are issuing the shares, okay, you are bringing the IPOs, but not 100% sure that every time public will purchase all your shares, है ना? So whatever this public are purchasing, that is subscribed share capital. So this is a portion of issued share capital that is subscribed to by the public, that is applied and allotted by the company. So during IPO, what as an investor we all are doing, we are actually purchasing those IPOs, है ना, but not 100% sure that every time we are allotted with the shares. Few times we are getting a refund. So that is a process. That is a process decided by a company whether you are eligible for those shares or not. So that is what subscribed share capital. If in return you get the shares, means now you subscribe those equity capital. Now you are a owner of those company. Okay, so that is what subscribed share capital. Chaliye, coming to the next, that is your called up share capital. Called up share capital is a part of again issued capital that the company has been called for the from the shareholders. So basically when companies they are issuing any shares in the market, okay, they brought any IPO for any company, and if they are asking amount in installments, when they are asking amounts in installments, that time they are going to call you, okay, for the remaining amount. That is what called up share capital. So the call can be one or more subject to the extent, regulations and need for funds by the company. Suppose company decided to issue 100 rupees per share, okay, this is per share amount, and company decided at the time of subscription they are going to ask for 20 rupees. Okay, then for next allotment time they are going to ask for next 25 rupees, and then next they are going to call suppose next 20 rupees. So when they are actually arranging these type of installments, this one is your subscription time, this one is your allotment time, okay, this time we are going to call them. So basically when companies are calling in installments, that is what called up share capital. Whatever remaining amount is left, in that if company is calling you for the repayment, that is your called up share capital. Okay, then paid up share capital. So when company is calling to their investors, okay, every time investors are not going to repay you, sometimes they are not available. So if investor is repaying you when you are calling them, then that is paid up capital. Investors are paying to the company of any remaining amount, that is what paid up capital. So paid up share capital is the amount of money a company has received from shareholders in exchange of shares. That is what paid up share capital. The amount of money a company has received from shareholders in exchange of shares. Okay, that is what paid up share capital. So basically when companies are doing this call process, ठीक है, and these investors are paying them money, then this payment of money is actually your paid up. And when company they are calling to the investors for the remaining leftover amount, that is your called up share capital. Then next, calls in arrears. Part of the called up or subscribed capital which the shareholders fail to pay the full or part amount. Suppose now company call to the investor, ठीक है, if investor pays them the money, that is paid up. But suppose now investor denies for the payment, that is now calls in arrears. Now when investors are not paying you the money after a call process or after a subscription process, that is calls in arrears, ठीक है, in which investors are not ready to pay you the amount. That is your calls in arrears. You made a call and investor denied for the process. That is what calls in arrears. So these are the different types of equity. First we started with authorized capital. This is your maximum amount of limit. Next is your issued share capital, part of authorized capital that are issued to the public. Then subscribed share capital, in which public are actually subscribing after you issued your IPO. Then next is your called up share capital. If companies are calling in installments, in that they are going to call you. That is your called up share capital. Paid up share capital, as an investor, now you are repaying to the company. That is your paid up share capital. Now as an investor, if you deny that I will not pay to them, okay, I don't want their shares, then that is calls in arrears. For whom? For the company, not for investors, for the company. Okay, this whole terms are actually for companies only, not for investors. This whole term is actually a point of view of company. Chali. Next is your internal accruals. See, whenever companies are earning profit, okay, whenever companies earns profit, and if their shares are listed, means now they have so many shareholders. So basically at the time of profits, now you need to give them some portion of dividend as a dividend, okay, of this profit when you are sharing to shareholders, that is known as dividends. But every time you are not giving 100% of this profit to the shareholders, because you also want to run your business. So this profit is your also income. So every time you are just giving a small portion. Suppose this is your 100% profit, you are distributing 10% dividend to your shareholders. Then only they will be agreeing for the continue process in your company, for continue investment. That is why you need to give them the dividends from time to time. So basically when you are not giving 100% of your profit as a dividend to your shareholders, so when you are retaining few profits, like 90% profit you retain in your business, for what? For more expansion, for more running of your business. Then that is your internal accruals. So companies do not distribute all earnings after tax to shareholders. All earnings after tax to shareholders means your profits. Your profits you are not distributing. Though you are giving them dividends, but not 100% dividend. You are giving partial dividend. You are giving like 10%, 20% as your board decides, as your management decides. But you are not giving 100% dividend to your shareholders. You are giving just a portion. Very tiny and minute portion to your shareholders. And whatever left amount you have, whatever left amount of your profit you have, that you are going to reuse in your business for more expansion for in your business. That is what internal accruals. Now this is the second source of money. First source you can take from your owners, okay, by issuing your shares into the market, from listing your shares into the market. First source of getting a fund is from that IPO. Okay, from that equity portion, from shareholding, from the ownership. Next is your internal accruals. Whatever business you are doing, you are getting profit. Through that profit, you are not distributing 100% to your shareholders, you are retaining in your business. So second source of money is your internal accruals. Okay, this is your second source of money. Now, retained profits, part of the profit after tax is retained in the company. See, government always asks you the tax, whether you are earning through a company, whether you are earning salary. Government always require money. So, whatever profit you have after paying the tax to the government, that is consists of two portions. One is your dividend portion and one is your company's portion. So after any amount you retained in the company, that usually reflects in the general reserve. That is your internal accruals. So retained profits are internal accruals arising from PAT, profit after tax, or non-cash profits like provisions or reserves charged to profit and loss account, like your depreciation, then depreciation charged to the profit and loss account. So these are the internal accruals through which company actually generate the funds. Then next source of fund is your preference shares. First one is your equity, in which you are diluting your shareholdings, in which you are inviting new investors, new shareholders. Second is your internal accruals. You are retaining portion of your profit in your own business, not distributing 100% of profit to your shareholders. Third is your preference shares. Preference shares means this preference shares also known as preferred stock. Now, why they are preferred stock? We will discuss. It is also known as quasi-risk capital. Quasi-risk capital. So preference capital, this provides a fixed dividend rate that is paid out before common stock dividends at the time of liquidity. See, common stock means your equity part. See, generally, when we talk about any company, for funds, what we can do, we can take bank loan, we can take bank loans, we can issue debentures. Debentures is again a kind of loan only. Then you can issue equities like IPOs we are seeing. Then you can also issue preference shares. Till now, we are going to talk about these things only. We covered your equity part. We are going to talk about now preference shares part. So as a company, when they are earning any profits, so firstly they need to distribute to their outside liabilities. Firstly they need to pay outside liabilities. Firstly, from this profits they are going to pay outside liabilities. After deducting outside liabilities, whatever profit they have, whatever profit after before tax, we call those profits. After giving outside liabilities, whatever amount you have, in that now you need to give the tax amount. You are going to pay the tax amount. After that tax amount, you are getting any amount, that is your profit after tax. So profit after tax includes two parts, your preference part and your equity part. But before paying to your equity shareholders, suppose any dividend, you require to pay dividend to your equity shareholders. So before paying any dividend to your equity portions, firstly you need to pay compulsory dividend to your preference shareholders. They are getting preference over equity. So if you are a preference shareholder, if you are a preference shareholder, you are going to receive fixed dividend. See, you are going to receive fixed dividend. But as an equity shareholder, there is no compulsion of giving dividend. That is the difference. That is the major difference. In equities, there is no liability for a company to pay dividend in each and every year. But if you are a holder of preference shareholders, then for sure you are going to receive fixed dividend. And next benefit of preference share is what? You are getting benefit, you are getting preference over equity. Means firstly, your amount will be paid. Suppose in case your company is winding up, in case your company is going to shut down, then firstly you are going to repay your preference amount. then after, if you have any leftover amount, you are going to pay to your equity. That is what preference. That is what preference. Okay, that is why they are saying that preference capital provides a fixed dividend rate that is paid out before common stock. That is your equity. Dividends at the time of liquidity. Liquidity means when your company is actually winding up or they're shutting down their business. That is what preference shares. So in exchange for this preference treatment, preference capital does not typically have voting rights like common stock. See, if you are getting some gains, if you are getting some advantages, so there are limitations also. Correct. So what happens? See, if you are a preference shareholder and if you are an equity holder, see, what are the difference? First difference is you are going to receive fixed dividend for sure. No fixed dividend for equity. Next you are going to receive preference at the time of liquidity. Firstly, your amount will be paid up before your equity. That is the preference. Then third, about voting rights. See, in any decision, if you are a preference shareholder, you are not invited. But as the equity, you are eligible for votings. For any rules and regulations, for any new setup if company wants to start, so company will ask you and you are eligible for those votings. That is the benefit, that is the difference also we can say between preference shares and your equity. Okay? Though they are getting fixed dividend, though they are getting preference over equity at the time of liquidation or shutting down of any business, but they are not having any voting rights. That is the difference between equity shares and preference shares. Now, we have different types of preference shares. Okay, first is here convertible and non-convertible. See, convertible means you have the option, you have the right to convert into equity. Means at the time of issue, okay, when company, suppose this is your A company. Company issued preference shares. So at that time, you are having all the features of preference shares. You are going to receive fixed dividend, you are getting preference over equity, okay, you are not getting any voting rights. All the features of your preference shares you are getting. But after a few years, if you have the option to convert into equity, means at the time of converting into equity, now your fixed right of receiving dividends, your preference over equity will lapse. Now you are going to receive voting right. So if you have the option to convert it into equity, you are called as convertible preference shares. The next, non-convertible preference shares. Non-convertible means you are not having, you does not have the option. Okay, you are not having or does not have any option for this conversion into equity, like normal preference shares. Okay, so that is what convertible, non-convertible preference shares. Then next we have redeemable and irredeemable. Redeemable means you have the maturity date, and remember in India you can only issue redeemable preference shares. Redeemable preference shares means you have some timeline for 20 years, for 30 years. That is the timeline. Okay, 20 years normally for each and every one, but 30 years, 20 years for each and every one, but 30 years in case of you are a infrastructure project company. Then you can issue preference shares for 30 years. But in India, you cannot issue any irredeemable preference shares. Irredeemable means that does not have any maturity date. Okay. That is the difference between redeemable and irredeemable. You redeem, you have time limit. Okay. Irredeemable, no time limit. Time limit, no time limit. Then participating and non-participating. Participating means after paying off your equity, also you are eligible for further profit sharing. That is what participating. Non-participating, you are only eligible for fixed dividends. That is the only difference between participating and non-participating. Then cumulative and non-cumulative. Cumulative means your right to receive of any dividend will never lapse. See, you are only eligible for dividends when you are earning profits. When your companies are actually earning profits, then only you are eligible for the dividends. But in case your company is incurring any loss, then in that particular year, your right to receive dividend will lapse. Yes or no? Yes, but in next year, if suppose company earns the profits, then firstly, they are going to repay your previous year dividends, then they are going to pay you the current year dividend. If this is the situation, then that is your cumulative preference shares, means your right to receive your dividend will never lapse. But in case of non-cumulative, your right to receive dividend will lapse. If in current year you are having losses in your company, then your right to receive your dividend will lapse, means you cannot carry forward your dividends. Like salary area we have na, like same this cumulative and non-cumulative works. If you have any salary in areas you are going to receive in future, like same in cumulative dividends, if you are not receiving any dividend in your current year, then your right to receive in future profits will also be there. You can carry forward your right. That is your cumulative. So dividends are accumulated and paid before anything paid to equity shareholders. Non-cumulative, company does not pay dividend in current year, claim of preference shareholder is lost to that extent. Then shares with callable options, means company has a right to redeem preference shares in between. Such preference will be redeemed at a premium if redeemable in between. Means suppose the time limit is 10 years, but company is actually redeeming in 5 years only. Then at the time of redeeming, company needs to pay extra amount, extra money. That is what shares with callable options. So these are the different types of preference shares. Chaliye, next we are going to talk about foreign direct investment. Foreign direct investment, as we all know, now companies, not only companies, countries, each and every country, like in India also, we are welcoming outside investors. We are calling outside investors to invest in our company. That is what foreign direct investment, that is your FDI. So we have FDI policy that is announced by the government of India, and we have the rules and regulations given under FEMA 1999. All your regulations related to your FDI is given under FEMA 1999. In this you have two routes. First route is your automatic route. Already government gave you some limits. Okay, that if you want to call any investments till this limit, you can call it freely. There is no obligations for asking from this government, for taking permission from anyone else. So that is your automatic route. So under automatic route, foreign investors or the Indian company does not require any approval from RBI or government for the investment. Already they gave the limit. But in case of government route, under this government route, prior approval is required from the Government of India, Ministry of Finance, Foreign Investment Promotion Board is required. That is your automatic route and government route. Okay, suppose if you want to purchase anything and you have 100 rupees, you can purchase it freely without any permission from anyone. But if you want to purchase anything which cost you 1 lakh rupees, now you will discuss with your family. That is same works here. We have no limit, that is your automatic route. Now you need to take the permission, that is your government route. That are the two different routes under FDI we have. Okay, chaliye. Now we are going to see next part under this, that foreign investor now can invest in Indian company which is a small scale industrial unit provided not engaged in any activity which prohibit under the FDI policy. See, the maximum investment any FDI can do is what? 24% of paid up capital of the Indian company or SSI unit. Okay, so this is about your FDI. Chaliye, let's start with questions. So equity shareholders are also known as owners of the company, creditors of the company, debenture holders, preference shareholders. Tell me. So equity shareholders are also known as the owners of the company. Then, which statement is true about retained earnings? They are distributed as dividend to shareholders. They are shown as an expense in the income statement. They represent the cumulative profits not distributed to shareholders. D, they are liabilities of the companies. In this, they are asking about retained earnings. That is same as your internal accruals. Okay, so they are distributed as dividends to the shareholder? No. They are shown as expense in the income statement? No. They represent the cumulative profits not distributed to shareholders? Yes. Your correct answer is your option C. In case of retained earnings, in case of internal accruals, whatever amount you are retaining, whatever profit amount you are not distributing as dividend, that is your retained earnings. Next, preference shareholders are entitled to receive fixed dividends, variable dividends, dividends only after equity shareholders, no dividends. Now this is your homework question. Already I told you what are the features of what are the features of preference shareholders. Now you are going to tell me the answer for this. A, B, C, D. Give me your answers through comments. Then, next, cumulative preference share means what? A, dividends are paid only for the current year. Dividends not paid in previous year are carried forward. Dividends are calculated based on profit growth. Dividends are paid at a variable rate. See, cumulative means you are going to add. Your right to receive your dividend will never lapse. That is what cumulative preference shares. So as per this, only for the current year? No. Dividends calculated on the profit growth? No. Dividends paid at variable rate? No. Your correct answer is your option B. Your right to receive your dividend will never lapse. That is the benefit of cumulative preference shares. And with this we complete your today's topic, that is your different sources of funds. See, now if you want to enroll in our courses for better concept clarity, for more revision, for more understanding of the concepts, you can visit to Adda 24/7. All courses JIB CAIIB June 2025. In this you can enroll in Mahapack 2.0, that is your CAIIB Mahapack. In this you are going to receive your concept classes. Okay. You are going to receive your concept classes. You are going to receive your crash course also. You are going to receive revision classes also, means one-time investment, and you are going to receive all the different classes. Okay. Then you are going to receive a mock test, that is your unit wise, as well as your full mock test, plus ebooks for your self-study, videos for multiple revision. See, understand your CAIIB is comparatively hard than your JAIIB. So if you are preparing for clearing an upcoming exam, then do enroll in this batches. Now, see, the best benefit of this particular Mahapack is you are going to receive double validity, but with that coupon code only. So that coupon code is Y895. See, right now you are receiving only 77% off. Okay. But as soon as you are going to use this coupon code, see, right now coupon code is Jan77. Okay. So you are receiving 77% off. But if you use Y895, you are going to receive 79% off plus double validity. That is the benefit of this coupon code. While you purchase the same Mahapack from Adda 24/7 app, you are going to receive 1% additional off. Means total you are going to receive 80% off plus double validity. So these are the benefits of your Mahapack along with this coupon code. Chaliye, so with this I am winding up this session. Thank you everyone for joining. Take care. Bye-bye. And do give me the answer of your previous question.